By the end of this video, you're going to better understand the Backdoor Roth IRA and leave with a better sense of who this might be best for. Now, what is a Backdoor Roth IRA? A Backdoor Roth IRA is a method used by high-income taxpayers to create a permanently tax-free Roth IRA, even if their incomes exceed the IRS limits for standard contributions to a Roth IRA. As always, just a quick reminder that our videos are for general informational purposes only, and we're not providing tax advice. So we do suggest folks consult a tax advisor for anything specific to your tax situation. With that out of the way, a backdoor Roth conversion is typically done by contributing a non-deductible amount to a traditional IRA, and then immediately converting these funds into a Roth IRA. These converted funds then grow tax-free in the Roth IRA. To fully understand the backdoor Roth, we first need to understand the Roth IRA. What is a Roth IRA? A Roth IRA is a type of individual retirement account that allows you to contribute after-tax money for tax-free withdrawals under certain circumstances. When we say after tax, we simply just mean that this is the money that's paid to you in your paycheck that's already been taxed. Funds in your Roth IRA then grow tax-free, and when you take qualified distributions, you are not responsible for any additional taxes. Now, why not just fund the Roth IRA directly? Well, the problem for high-income taxpayers is that individuals who earn above a certain amount are not allowed to open or fund Roth IRAs, under the regular rules anyway. So, if your modified adjusted gross income exceeds certain thresholds, then the law starts phasing out the amount that you can contribute. Once your annual income exceeds a specific threshold, you cannot participate at all. For the tax year 2022, that threshold is $144,000 for single filers or $214,000 for joint filers. If you exceed these income thresholds, you cannot contribute to Roth IRAs under the standard IRS rules. Now, traditional IRAs, on the other hand, do not have income ceilings for participation. And since 2010, the IRS hasn't had income limits that restrict who can convert a traditional IRA to a Roth IRA. As a result, the backdoor Roth IRA has become a tax planning opportunity for higher income taxpayers who ordinarily cannot contribute to a Roth IRA. How does a backdoor Roth work? You can create a backdoor Roth IRA in one of three ways. Number one, contribute money to an existing traditional IRA and then roll over or convert the funds to a Roth IRA. Number two, convert your entire traditional IRA to a Roth IRA. Or number three, if your company 401k plan allows conversions, not all do, you can roll over your 401k account to a Roth IRA. Now, how does this help you? Roth IRAs don't have required minimum distributions, which means that account balances can create tax-deferred growth for as long as the account holder is alive. You can take out as much as or as little as you want, whenever you want, as long as it's after you're 15 and a half and you've held the account for 5 years. Or you can leave it all for your heirs. Qualified Roth IRA distributions, unlike traditional IRA distributions, are not taxable. This can mean significant tax savings in retirement. The main advantage of a backdoor Roth IRA, as with Roth IRAs in general, is that you pay taxes upfront on any pre-tax funds converted, and then everything after that, principal and earnings, is tax-free. If you think that the tax rates are maybe going to rise in the future, or that your taxable income will be higher in the years after your backdoor Roth IRA is established than it is now, then this can work to your advantage. Now, who is it best for? If you are over the income limit to contribute to a Roth IRA and like the idea of tax-free growth, the backdoor Roth might make sense for you. It's a great tool to get your retirement funds in the Roth IRA, even if you are not technically eligible. If you're not over the income limits yet, you don't need to worry about this, as you can keep making those standard contributions directly to the Roth IRA. And as I always say, if you're under the income limits, you should always be maxing out the Roth IRA. It's a great tool. Now, the big key is, what are the tax implications of doing the backdoor Roth? It can vary, right? If you contribute post-tax dollars to the traditional IRA, don't have any other funds in any other traditional IRAs, and then convert just the post-tax funds in the IRA to the Roth IRA, there should be no tax implications. That has to be post-tax funds though. If you do have other pre-tax funds in any traditional IRA, not just in the current one you're converting, but others, you may incur taxes in converting your funds, even if you only convert the post-tax IRA funds. This is key. For tax purposes, the IRS treats all of your traditional IRAs as a single aggregate IRA, and this is sometimes referred to as the Pro Rata Rule. To calculate how much of the converted amount is taxable, the IRS uses the following formula. Stick with me here. Taxable amount equals total pre-tax dollars in all of your traditional IRAs divided by total dollars in all of your traditional IRAs times the converted amount. To put that in more concrete terms, let's run through some examples. Example number 1. You have one traditional IRA with $6,000 in post-tax money, and you convert all of it. That means you did not take any deduction for that contribution. In this case, nothing should be taxable. If you don't have any investment gains or deductible contributions, i.e. none of your IRA holdings are pre-tax, you would not incur any taxes from this conversion. Example number 2. You have one traditional IRA with $6,000 in post-tax money and $100 in investment gains, and you convert all of it. In this case, the $100 in gains is taxable, the rest is not. If you convert your one and only traditional IRA, you're simply taxed on the pre-tax money in that IRA. In this case, the investment gains. All right, let's get to the tricky one. Example number 3. You have two traditional IRAs. Doesn't matter where they are. A Wealthfront traditional IRA with $6,000 of post-tax funds, and then a traditional IRA at another brokerage with $18,000 in pre-tax funds, like maybe a 401k that you rolled over. You convert the full value of just the Wealthfront Roth IRA, $6,000. What you'll see here is that $4,500 might be taxable. Even though you're only converting post-tax funds at Wealthfront, you may incur taxes based on the percentage of pre-tax funds in all of your traditional IRAs. In this example, 75% of all of your traditional IRA money is pre-tax, so 75% of your converted amount would therefore be taxable. How can you do this with Wealthfront? To complete a Roth conversion, you first need to open a traditional IRA or SEP IRA. If you already have a Wealthfront Roth IRA, go to your traditional IRA account page and on the top right, select Manage, Convert Funds to a Roth IRA. It's that simple. If you don't yet have a Wealthfront Roth IRA, select Open New Account, select Investing, Retirement, Roth IRA, and then select your traditional IRA as the account for funding. This is Tony from Wealthfront. Thanks for watching.